Welcome on board, Jitendra Senior Fund Manager at Baroda Mutual Fund, joining in on the show right now to talk about where he sees the market headed from here next. Jitendra, hi, great to have you today on ET Now. Morning, firstly. Wanted to understand where is it that you've picked your bets from within the entire, broader market space, especially given how the Q1 earnings have panned out, which have largely actually managed to turn out a beat as opposed to what one was anticipating stepping into the earnings.
Yeah, good morning to both of you and also to your viewers. When I look at the earnings broadly, I would say that one sector that has been a relative standout in terms of earnings has been the auto space. The numbers have been much better than what the street was anticipating. One key element has been there. What we need to see there is a sustainability, because if you recall last year, there was obviously this talk around GST cuts coming through in September, which led to some deferral of demand into the festive season. So 2Q will have a very soft base, but again, we'll need to look at how 3Q on a YOY basis comes through. But that's one space we have been positive on. Second, I would say, has been the entire power and electrical equipment space, because the tightness in the market there continues. And broadly, West Asia has also given some push factor there, because energy being fungible, people obviously gravitate away from hydrocarbon-based energy sources to, the electricity-based ones. Just like, you switch from an ICE vehicle to an electric vehicle, or you move from, say, a cooking gas-based mode to an induction cooker or something like that. Those things are definitely happening. So to an extent, that is something that we are definitely keener on. The other added part, I would say, is that tech is something where we are becoming far more cognizant of the price levels and the improving dividend yields. Frontline names are now trading at almost about 5% dividend yields, etc. And these are high quality balance sheets. So if we used to be, say, 300 or 400 basis points underweight versus the index in, say, February of this year, the first knockdown which came because of AI-related threats caused one level of price carnage. Then in April, again, you had these growth-related price carnage, or the concerns that came in, which led to one more round of price drops. What I'm saying is now, at least from a price level, it doesn't make any sense to us to be the same magnitude of underweight as what we were earlier.
Okay. And therefore, Jitendra, what sectors are you most constructive about? If you can give us some color on that first off.
So the major sectors that we are overweight on at this point of time is healthcare. That's something which continues to be a fairly stable ship as such. So that's one area we are positive on. Second part, as I mentioned, the utility space, the energy fungibility argument there. And thirdly, some part of the capital goods space, especially the power equipment place, is something we are very positive on. So these are areas that we are broadly quite hopeful on from a FY27 perspective.
Okay. And Jitendra, I'm going to delve a little bit deeper into power, because that's a space which you seem positive on. These days, you've got some of the faster growing companies within the power ancillaries kind of space. Would you at all consider any of those, and the kind of drawdown that we've seen on some of those names, along with the kind of growth we continue to see? Does that pocket look attractive to you?
Yes, it does. So power equipment is a space that we are quite positive on. So whether it be on the generation side where people make power equipment, or whether it's on the transmission side where people are building, bidding for HVDC equipment or substations, etc. Those are areas that we are quite hopeful on, because the entire ecosystem, given the fact that renewables as a proportion is constantly rising, means that the grid will need constant upgradation. So one is the core aspect of India becoming more electric power oriented and trying to reduce its reliance on hydrocarbon based sources of power. The second is the evacuation and the distribution when you have more and more of renewable power flooding the system. So both areas are quite exciting to us from a longer term perspective. So you may have situations where some of these power equipment stocks may have rallied very hard in the last 5-6 months. They may stop, consolidate a little bit, and then resume their uptake and all that. But that's more a kind of shorter term trend. The longer term trend remains very constructive there.
Okay, what about the financials, Jitendra? What's the view there?
Yeah. So at this juncture, we are neutral on the space. So there is a little bit of balance coming through in that. One part is on the clearly on the issue that RBI is increasingly getting better, more increasing confidence on the inflation trajectory. In fact, in the recent MPC, they have actually toned down inflation expectations by about 10 odd basis points. So at least the comfort factor seems to be coming back on there. And the second part is this related to FCNR deposits and all that. The numbers are now indicating that we should actually be slightly, north of the 60 odd billion dollar mark somewhere. So it should give some stability on the currency as well. Now, see, the one part that we are seeing across the board is that the state-owned sector seems to have slightly a better NIM improvements kicking in, whereas the private sector is holding on, or there's a marginal slip up on the NIMs as such. The area where we are a little bit concerned is because you have a situation where if say a XYZ bank has a branch in the Middle East and they're raising deposits from there, already the deposit, when you're giving leverage on that FCNR core equity that the investor is putting in, you're already leveraging the balance sheet there itself. So incremental LD or CD ratio support that you may get in the domestic may be very marginal. So we are not big believers in the fact that it will lead to a system-wide improvement in CD ratios. So that is something that we don't think is going to happen in a material manner. So, but the fact remains that you are going to see currency stability. You might see some amount of money coming from overseas markets to domestic markets as well. So those things should improve the broader liquidity scenario in the local markets.
Chitra, I'm curious to know, purely because the street is still not 100% convinced, but there are a few contra investors out there about whether or not you finally see value and growth visibility for IT.
So I think value, is definitely there, because see, one part is we are talking about companies that are sitting on huge amounts of cash. Balance sheets are quite pristine. You have some of the best governed companies in the space as well. So the fact is that you are having high cash, very reasonable dividend yields of around 5% on these companies. So from a value perspective, I don't have a doubt whether they are there. Now, the argument can be on how much does AI impact, how debilitating can it be, whether it the way I would put the argument is, I don't think it is going to spell a doomsday for Indian tech. It might be a situation where you may have a little element of, contract value reductions or stuff like that, because there will be productivity gains coming in. So we will need to constantly focus on players who are slightly more adaptive, who are quicker, more dexterous in terms of being able to adapt to the situation and cater to areas that are more digitizing faster. Also, if you look at the data stacks for a lot of the clients, they will need to become AI ready as well, which should offer some opportunity for Indian tech in terms of the migration work there, making the data ready. So I'm not such a big believer that it's doomsday. And we've also seen companies forget commentaries, etc., etc. I think the bigger thing to read is what is the actual decisions. Even if I look at some of the attritions that are happening at a manpower level and all, you're talking about 1-2%. I mean, it's not like the companies which are in the business, they are seeing the drumbeats as such. They are taking very, very negative things. They may be realigning their workforce, moving away from legacy systems, moving into more AI related talent, etc., etc. So there may be some amount of repositioning themselves for the opportunities that are now changing, but it does not seem to be indicating that they are seeing a massive carnage out there.
Okay, great to have you on the show. Thank you so much for your time today.
Yeah, thanks so much. Thank you.
Okay.